And there's so much money in Silicon Valley to help people starting up new companies.
So much.
That we are growing so much faster than what's leaving.
Right.
I don't think it's going to hit us particularly hard, but it's going to open up this opportunity for people to basically renegotiate what their mortgage situation is by refinancing into a new one. I wrote a computer program that we put on their computers, so they did all the keystrokes for the heavy lifting up front, and then we did everything else behind the scenes. But what I did is I found a very easy way to allow that financial professional to do enough of the work on a mortgage transaction to get paid without it being a violation of RESPA. What we don't have right now that we had last year is there was a lot of foreign money coming in that just isn't coming now.
Hey guys, so today we have none other than Russell McDonald. If you have seen, the JX4 comments, things like that, comments on LinkedIn, then you know who he is. But you're about to find out much more about him. And I'm going to let him tell you a little bit about himself right now. But he's based out of the Bay Area. And this is going to be a super interesting episode for accountants and CPAs because Russell McDonald is not an accountant, correct, sir?
That is correct.
He's not an accountant, but he definitely helps them out a lot. And he's definitely been a valuable, what do I call you? A personality online, a personality on LinkedIn. And this is one of your first interviews on a podcast, I believe. So
yes, it is.
Man, very exciting. I'm very honored to have you on the show. But just to get right into it, I feel like I had talked too much. Even my audience may know that. But would love for you to tell the audience a little bit about yourself, both first off with what you do exactly, and let's just start with that, and then I'll get into asking you about your origin story, how you got here. But tell the audience a little bit about what you do right now.
Okay, so my name is Russell McDonald. Like Juan said, I'm in the San Francisco Bay Area, and since 1992, I've been a mortgage broker. And so currently I'm a mortgage broker, real estate broker, and I'm an inventor.
I like
what the focus of my business is now is working with CPAs, enrolled agents, financial planners, basically to work as a resource with anybody who has a captive book of client business to help them manage their clients' mortgage obligations so that their clients know when it makes sense to refinance, so they don't get ripped off by the big box lenders that try to confuse you into paying far too much in points and fees to get a lower interest rate, and basically help those CPAs and financial planners manage that aspect of their clients' lives. Because a typical consumer may get 3 to 5 mortgages in their lifetime. If they're really active on following the market, they may do it 10 times. And if they don't know what they're doing, they'll almost certainly not do what's in their best interests. It's really easy to confuse people with such a complicated transaction.
Right. And let me back you up right there in terms of saying that, I mean, my clients, I don't have I don't have hundreds of clients. There's no cookie cutter approach that we do with our clients. So we have very high status clients that really care about providing the best service to their clients, which are business owners, right? CPAs and accountants providing services to their business owners. And when their business owner clients, their corporations, or maybe even sole proprietors ask about certain topics, they definitely don't just sell things to them, right? It has to, they try to get an ROI approach out of it. So I think definitely going with the right vendor or being conscious about fees and such are definitely important to my clients. So that's super interesting.
No, excellent. And, one of the things is, I saw something about 20 years ago from a CPA trainer, and what he was just pounding into his CPAs is that they need to find a way to become the financial service center in their clients' lives. And even 20 years ago, he was talking about changes that are coming to where they're going to try to automate, they're going to try to push you out, they're going to try to start having people do things online. And what you need to do is find out whatever you need to do to become important and become more intertwined with their daily needs. And so that's kind of why I started up the systems that I did. And what I did is, some of them don't want to participate in the transaction the way that we allow them to. They just want someone on their team that they can trust to get everything done correctly. But what I did is I found a very easy way to allow that financial professional to do enough of the work on a mortgage transaction to get paid without it being a violation of RESPA. And so when we first started out, I wrote a computer program that we put on their computers, so they did all the keystrokes for the heavy lifting up front, and then we did everything else behind the scenes.
That's super interesting. I didn't know that.
Yeah, that's how we came up with it. It actually first came up for home builders and realtors, and I finished the product in 1998, and that's when we applied for the patents on it.
Mm-hmm.
And the market just took off at that time. So instead of, like in the early to mid 90s when builders were barely breaking even on their homes, they were making $50, $100, $250,000 per lot. And so they didn't really care about the little bit of extra that I could put on the table. And so that fell by the wayside. But at the same time, CPAs in California got deregulated as to other side businesses and the ability to get commission income for businesses other than accounting. And so we just slipped right in and hit the ground running.
Right. So do you also serve CPAs and accountants and financial advisors outside of California?
Right now, I only do California.
Okay, California.
This is
That's
actually
awesome.
a new company. The company I left, which has a license to use those systems that I invented, is licensed in some other states. What happened is the technology is owned by a software company that I founded in 1994 with two other people.
Interesting.
And those two other people owned the mortgage company I was working for. So the entire time they were still working, they wouldn't let me go off on my own with the technology, even though I'm the one who wrote it.
Right.
So when they retired, they finally said, okay, you can go off and start your own company and you can take the technology with you and use it there, but still pay the software company the same royalty the other mortgage broker is paying it. And that's where I'm at right now, is just trying to get this up and running.
Yeah, I mean, I've seen you online, and just so that the audience knows, if you've seen any episode of CPA Primetime, you know that I don't just invite any willy-nilly guest on just because I need guests. So actually super exciting to hear from Russell McDonald here. And, my CPAs in my network trust him as well as some of my clients. So very excited to go deeper in this interview. But why don't we backtrack now and get into more of your origin story? How did you get here? What's your story, Russell McDonald? Tell us.
Okay. So like I said, I got into mortgages in 1992. And at that time, we were looking for other businesses loosely related to financial transactions to expand the business out so that when we had bad years on mortgages, we might be able to do other things. One thing we looked into was equipment leasing. And we wanted to first of all, whenever I've come up with a product, and I've come up with 8 or 10 different products specifically for our needs over the years, and written the software for it, what we would do first is we would go out and try to find it so we could just buy it.
Right.
And anytime we had a specific need that we thought we had that didn't exist in the market, we thought, well, hell, we pay $5,000 for this. We should create it and go out and sell it. And of course, it never sold as much as we thought it would. And most of them we never actually even offered to the public because we didn't get beyond that that threshold there. But so the first product I came up with was actually for equipment leasing brokers to find the funding source that could do a specific deal. Because I thought that what they would be most interested in is finding whoever's going to be best at it and pay them the most and do it the fastest.
Okay.
Well, most of them just had their preferred sources and didn't really want to go beyond that. You know, if tier one or tier two or tier three wouldn't do the deal, they just stopped looking. Whereas the way I learned how to do mortgages so well is if I had a transaction that wasn't normal, no, not a non-vanilla brand transaction, we used to get 70, 80, maybe 100 pages of rate sheets on our fax every single day from different banks. And so I just grabbed the rate sheets from the day before and call every single one and say, look, here's the deal I have. Can you do it? How can you do it? What's that going to look like?
Right.
So it's just the tenacity. Well, when I came up with this searching program for equipment leasing brokers, I would come in the office every day at 6 o'clock in the morning here on the West Coast and start calling firms on the East Coast that were just opening to get them to fill out my questionnaire. And so I called every single equipment leasing company I could find in the country over a period of several months. And I created a search system, you know, sold 30 or 40 copies nationwide, and that was it. So we sunk about $30,000 into creating it. Obviously, we didn't make any money on it. But we started moving forward with other things that we came up with. And sometimes we would come up with software ideas to give away for free, just trying to drum up business. And in 1993, I actually came up with the concept for this system. And the owners of the mortgage company that I was at basically said, no, you can't do that. It'd be against the law if we don't go to jail. Because as you probably know, in the United States, it's not legal to pay a referral fee of any kind on a mortgage transaction if it's residential. Now, it's commercial, that's a different deal because those are not subject to RESPA. And so what I said is, look, so I write a computer program so they do the work. What are the steps? Well, nobody could answer that. And it took me about 4 or 5 years just to convince them that we could do it legally. And I wrote the program and we kind of ran with that.
Interesting.
And then other things I do, one of the other programs I wrote that's covered by the patents is a tracking system that compares each of our clients' rates every day with where the market is. And if anybody can refinance on a no points, no fee basis and save money, it spits the name out and tells us to talk to them.
Interesting.
So
that's very cool.
A lot of people think that it's smart to pay extra closing costs and buy down the rate. Because people pencil out how, well, if you hold the loan for 30 years, you're going to save this much money over 30 years. The reason that banks give you a cheaper rate in exchange for a lot of money up front is they've penciled out that that's usually a better deal for the bank than the consumer. And let's be honest.
Love it.
So I've got clients who over the years have refinanced their homes 10, 12 times, each time for a cheaper rate and each time without paying closing costs. Because anytime they can save 1/4 to 0.5%, they should do it. Most of my long-term clients have rates in the mid-3s right now. We did them back in 2016. So whenever the market shoots up, things are a little bit dry for me as we're trying to do things because most of my clients just ride it all the way down unless for some reason they decide to sell their house and buy another one, or they have financial problems where they have to take a cash out loan. They just sit pretty at whatever the last low point was for them.
Right. That's super interesting.
So that's kind of the way I've built my business over the years. Now, it's funny because on a given day, a lender may offer me 15 different rates for a 30-year fixed rate mortgage, for example.
Right.
And each of those rates may have or will have adjustments based on risk factors on the loan. So from just one lender across all their programs, I may have 400 or 500 different options, just feeding it into different things as far as what people can do. But they pay me the same for a given loan size whatever the choices are the client makes.
Mm-hmm.
So from that standpoint, it doesn't matter to me what the client takes. I tell them what I think is in their best interests. And the fact of the matter is, when you pay extra to get a cheaper mortgage, it usually takes you between 4 and 7 years to make up the difference on the excess closing costs you pay up front.
Okay.
I had a client in 2012 who wanted to pay extra because they thought it'd be worth their while. So I took their specific loan size and loan type, analyzed thousands of transactions we've done going back. That would have been 20 years.
Wow.
And the only time that someone doing that transaction could have paid extra and made out ahead was in April of 2004.
That's interesting.
They would have broken even at about 2010. And from 2010 to 2012, rates were higher than that. But in 2012, when they started all the quantitative easing and the Fed started buying $80 billion worth of mortgages and treasuries a month and all that fun stuff, rates just took a nosedive. And so they would have had 2 to 3 years of upside before the market gave it to them for free anyways. Now, someone in 2012 or 2013, if they paid extra, it would have taken them until about now to break even. But post-Brexit, rates dipped even lower in 2016. So the lowest we've ever had was about October 8th, 2016, 3 weeks before the election. And so it's possible that someone playing that game to buy it down the rate at that time could have made it out ahead, but we're not going to know that until about 2022.
Okay.
And since we already have indicators that we're heading into another recession, realistically sometime the next year to 2.5 years, rates are probably going to be even lower than that before 2022 comes around.
Right.
So it's really hard to bet against the market and win.
Of course.
Now, sometimes there are people who want to pay extra closing costs or buy down the rate because they're not spending their money.
Okay.
You know, if you've got a real situation where your job is moving across the country and they're willing to pay 3 points to get your rate bought down, well, if they're paying for it and you're not going to be taxed on that money, why not? Or you may have someone who says, look, I'm going to be retiring in a year and I just want to have this payment at this level for the rest of my life. Fine. Sometimes it makes sense, but only if you know you're not going to be able to refinance in the future, for example. Or sometimes there are tiers or nuances about your transaction to where a no points, no fees option just isn't in the cards. Sometimes the lenders just won't do it.
Man, I think, you know what, I really appreciate what you've said already. I think, by the way, audience, this is such a valuable interview. If you have, if you have a numbers background, right, if you have a financial background, then I think this is super valuable for you. If you don't, you may want to already be taking notes and Googling some of the things. But these are some of my favorite interviews, interviewing, women and gentlemen with experience, even though, I have new people that are newly minted CPAs on, or people that some people may call rookies, right? But to just hear from someone that has been in the market and has been serving the market for so long, I mean, you can't buy experience, basically. That's the way I put it, which is why I'm a big fan and supporter of JJ, the CPA, right? And I really love to see people survive in the market. That just tells me a lot about an individual. And so really appreciate your time here, but would love to backtrack and go back to what you said about the indicators of the market right now that you're seeing. So would love to hear your opinion on those indicators.
You mean as far as the signs that we're heading into a recession?
Right.
Okay. So this is an interesting thing that's happened. For the last 7 times we've gone into a recession, at some point, 1 to 2.5 years beforehand, the yield curve between the 2-year and 10-year treasuries is inverted. just briefly. It doesn't really stick there. But every single time it's happened even once, going back to the 70s, we find ourselves in a recession. Now, there are a lot of people, because I started putting out some videos about this and talking about it and posting
Right.
about it. And I had some people reach out to me and say, dude, you're overreacting. It's not going to happen.
People
It's going to be different
saying
this
that,
time. We always say it's going to be different this time, right?
Right.
So my feeling is it could be different this time, but let's face it, it's not going to be different this time. So we have this indicator that has only happened before a recession, and we've never had a recession going back to the 70s without that indicator. So that's why I'm really confident that we're heading into one. I hope that here in the Bay Area, it's not going to hit our housing prices the way the last one did, because this one isn't necessarily real estate based. And even though we have a lot of companies that are leaving California because of the tax situations or political situations or whatever the reason is, more are coming in. And there's so much money in Silicon Valley to help people starting up new companies.
So much.
That we are growing so much faster than what's leaving.
Right.
I don't think it's going to hit us particularly hard, but it's going to open up this opportunity for people to basically renegotiate what their mortgage situation is by refinancing into a new one. Now, and I could just sidetrack for a second, one point that I should have brought up before. Anybody who purchased their home in the last few years that still has any kind of mortgage insurance, whether it's PMI or the FHA MIP, they should look at getting out of that as fast as they can if they have the equity right now, just in case values do take a hit. Because
that makes sense.
Rates drop down into the 3s or into the 2s, but you can't refinance because you're underwater. That doesn't do you any good. And so for people that have purchased homes recently with regular conventional PMI, there are terms in their loan that say when it has to fall off automatically anyways. So it's not catastrophic for them if they don't get out of it. But if they can save money and get a cheaper rate and wipe out the PMI, there's no reason not to. Now,
that's
when it
interesting.
comes to the mortgage insurance premium on FHA loans, people have gotten those out since 2015. That never comes off. So it just doesn't come off, which means even if the value is there, they're higher premiums than regular PMI, and they stick with the loan because that's what the FHA is using to fund their program.
Okay.
So look at it as a tax, not as insurance, because basically they're helping pay for administering and keeping the program going forward. They charge an upfront mortgage insurance premium of 1.75%, and then ongoing at about 0.85 per year, depending on the situation. So it's expensive.
Right.
You know, someone with an 800 credit score who's putting down 5%, right now their PMI factor is only about 0.21. So someone who can do conventional instead of FHA is going to save a lot of money. It's higher for lower credit scores, but you've got to get down below about 650 before conventional PMI gets more expensive than FHA. So that's just, sorry for sidetracking like that, but anyone who is still paying any kind of mortgage insurance needs to see what they can do to get out of it.
No, I think that's valuable advice. And I mean, from what I've seen from CPAs, me being such, a young individual in this market, the accounting market, to where when I came over to Silicon Valley, I had cryptocurrency companies, right? Blockchain companies trying to recruit me away from PwC because they're like, hey man, accounting is such a hard field. You're going to have to be in there 10 years until you're actually good. You're already good at marketing. Come market for us, right? That's what blockchain companies were telling me. And I realized that to be true in terms of when I went to PricewaterhouseCoopers orientation. I mean, no knock on my other colleagues or associates. I mean, they're very smart and they can figure out accounting over time and numbers over time. But I just expected I expected my peers to be more educated about the Treasury, about the USA's financial situation, about their own financial situation. And sometimes CPAs are just not as financially literate as, you know, as people as people think there are. And that, again, that's no knock on CPAs. It's just that from what I observed, you're an expert at something or in a specific area if you're an accountant or a CPA, and you do that really well. And I've kind of read the telltale signs from looking at different experts, right? Specifically in my own experience, I mean, my colleagues had no clue what to do with their 401k, right? Because I was such an entrepreneurial minded individual. I knew exactly what I was going to put and not put in my 401k, right? And at orientation, we had to make that we had to make that commitment right there at orientation. And I was ready. I had my plan down, right? The rest of the table, they did not have their plan down, and they were kind of asking me, what should we do? Right. And I was like, whoa, hey, I don't know I don't know what you want to achieve in life. Like, I don't know your financial situation right now. So like, I mean, don't copy me. Right. That makes no sense. So I think I say all that to say this. I think you are such a valuable resource to CPAs and accountants in your area of expertise, because I know really well established CPAs and accountants that can help people both make and save a lot of money that have no clue what is going on with rates or the Treasury or the USA's financial situation, right? So very curious in how you can help CPAs, and that accountants are some of the people that watch this show. So definitely curious about that.
Sure. So the way the system works that I use with them is it's basically a business method where, for example, you've got CPAs that are doing insurance products now, or that are selling investments.
Mm-hmm.
If they want to be able to provide mortgages to their clients and be paid for doing it, there's licensing that's involved, there's education up front, and then there's annual CE for one portion of the license, every 4 years for the other license. And they have to do certain steps on each transaction in order to qualify to get paid. If for any reason we skip those steps, then it becomes an illegal referral fee, which can be a real problem.
Mm-hmm.
Now, in the past, the company I was working at before has been investigated on 2 different occasions by RESPA, at least once by the California Board of Accountancy, by the regulators in Washington State, because they were like New York State banking department also came out and audited different things.
Interesting.
And that was such a hassle. They let their New York license go after that because they weren't getting any business there anyways.
Mm-hmm.
And it was just very expensive and very time consuming. So it's been looked at, and what it is I've designed a bunch of steps that they follow so that they are doing so much of what HUD has determined to be the steps in originating a mortgage that there's no question about whether or not they qualify for compensation. The work that I have them do takes them a total of about an hour per transaction. And that's where they had an issue with it, is they were saying they're not putting enough time into this, but it takes them about an hour per transaction, and they do 6 to 8 of the 14 steps that RESPA has defined a mortgage transaction as.
Mm-hmm.
So I just made it very easy because I made their computers do the work with them doing the keystrokes.
Mm-hmm.
And so what we pay them generally is half a point on the mortgage transaction. Over the past year, the people that are using that system have been averaging just over $2,200 per transaction.
Mm-hmm.
Takes them about an hour, takes me about 30 days to close the transaction from start to finish. So they're going to do their hours spread out during that time. And it's very easy, and the clients love it.
Awesome.
And so
love it.
that's how I put it together. Now, some other ones just say, look, I just want my clients taken care of.
Mm-hmm.
So I'm not going to get licensed. I'm going to call you if I need something. You can come by and sit down with them and walk them through it, and you just take the ball and run.
Mm-hmm.
So I can do it either way. But what I like to do for them is, and this is one of the things I saw on one of the JX4 episodes when you guys were talking about people that reach out to CPAs to do different things.
Mm-hmm.
And either Justin or JJ were talking about how, what they wanted, they just want to get my client list and start attacking them and spamming them for information. I don't want your client list. I want you to do the work with your clients. And for most of the time, the CPA is the first point of contact on every single transaction.
Sure.
If your client, John, is paying 4.5% right now, and I take a look at what his equity is and remember what his credit was like in his income situation, and I say, look, we can take him from 4.5 to 3.875, and it's not going to cost him a penny. And I tell you to reach out to him and offer that to him and put the paperwork through the online system, and then when we get everything in that you've provided to us, we take it and run with it. But generally, it's best for the first point of contact to actually be the CPA or financial planner on motion.
Right.
Does that make sense?
That does make sense.
Relationship with the client.
Of course.
And so one of the things that we ask them to do is when they meet with their clients every year to go over taxes, and they're going through the information on the deductions, ask them what their mortgage is. They don't have to give you the client's name, but if they say client number one owes $453,000 and his rate is 4%, then I know to reach out to that CPA when I can do a standard vanilla brand refinance at 3 3/4.
Right.
And so it's really simple. I mean, my normal pitch when I'm actually sitting down to talk to someone about it, it only takes me about 15 minutes to lay everything out and say, look, here's how we do it. I lay it all out on just a one-page sheet that I leave with them. Say, look, if you want to do it, we can do it. If you have any concerns about it, then send me one transaction. Have one of your partners who's paying too much right now come to me, and I'll show you how fast we can do this. And on a clean mortgage, we can have someone sign their final paperwork in 3 weeks.
Interesting.
So the idea is make it the easiest transaction they've ever had. I know my business well enough that what I try to do is I try to ask the clients for paperwork once. Because it is just so annoying when every single day the lender calls back and saying, well, now I need this, and now I need this, and now I need this. And they ask for things they already have, or they disagree with what you've done. So whenever the lender comes back to me and tries that game, I always go and fight with the lender first before bothering the client. Because I don't want to have the clients produce anything that they don't have to.
Of course.
And, I had one that I did last week for someone who's an attorney, and he just said, this is so easy. I've never had a transaction go this smooth before.
That's awesome.
This guy had a 780 credit score, and he had $500,000, $600,000, $700,000 in equity. Just a standard conventional loan, and there was no reason for it to be difficult for him. But he says, every time I've done this, it's hard.
Interesting. That's super interesting. So, I mean, the business people out there that are listening to this podcast, I mean, I would definitely look at Russell McDonald as an extension of my own business. And this is kind of how business is done now. People, CPAs look at me as an extension of their business, right? They don't hire an entire marketing department. They just hire me and my team, right? So they don't necessarily have to hire an in-house expert at what you do by salary. They come and hire you if they want to provide what they like to call, and I hate this word so much in the market right now, but if they want to provide to their clients a value add, right, I think you provide a really good value add. So that's super interesting. Thanks for sharing that.
No, most definitely. And, I know there are other companies that have tried this over the years. The only other company that has partially gotten it right is the company I left.
Mm-hmm.
And that's because I built the systems and I put it together the way I thought it should be done.
Nice. Go ahead and say that. This is the show to say that.
Yeah.
Yeah.
And, I've been awarded 6 patents for these systems that I've come up with.
Mm-hmm.
And they're really vastly encompassing. I mean, there's about 400 claims between them. We actually got
Interesting.
someone tried to petition the Patent Trial Appeals Board to invalidate 2 of them.
Interesting.
It is supposedly a consumer watch group that's funded entirely by a banking conglomerate.
Oh, come on. Okay.
and they do things like, this consumer watch group does things like file amicus briefs in lawsuits that the member banks that own their parent company. Yeah, I mean, just a lot of really strange stuff. Let's see, over the last 15 years before this happened, I talked to every bank I knew and made presentations about my systems, and some of them just took it and ran with it without
Mm-hmm.
contracting us.
Mm-hmm. Mm-hmm. That's
And so
interesting.
we worked with some people to go after and say, look, you got these ideas from us, you're working with it, you're doing it on your own, and you're violating these patents. And so
Of course.
they were going after, and that's why this watchdog group came after us. So they filed 3 inter parte reviews to try to invalidate 2 of them with about this big of a stack of paperwork. Just their filing fees on this were somewhere in the range of $220,000, plus all the attorney's time in putting that all together. And
Right.
of course, since I would have been on the hook for defending the IPRs, the litigation team at my patent attorney's office was all of a sudden salivating, thinking, well, instead of just getting fees for licensing, we're going to get fees from them to defend this. And I said, look, let's take a look at this first. And rather than defending our point, let's see if we can attack the petitions.
Interesting.
And so for a total of about $10,000, we got 2 of the 3 IPRs thrown out completely because they didn't meet the minimum requirements. And they got almost everything thrown out on the 3rd one, except they were allowed to institute proceedings against 6 claims out of the hundreds and hundreds of claims I have. And so we said, okay, we'll just give those up.
Right.
And we were
That's
done.
real good.
So they were planning, my attorneys were planning on making $150,000, $200,000 off of us in fees. And we ended up solving the problem for $10,000 just by thinking outside the box.
Nice.
And that's the sort of thing I like to do. Is I like to, when people tell me you can't do it that way, I like to take a step back and think, how can you do it that way?
Mm-hmm. Nice. I mean, I love it. I definitely, I'm super appreciative for some of your stories here. And, man, you know what? One of the things that I'm kind of, you know, I kind of wish the accounting market would do more is kind of show their career and their reputation more. Because right now, I mean, it sounds like you're showing off, right? It sounds like you're showing off, but you're simply talking about what happened. And
this is how I got to this point.
Yeah. If that actually happened and Russell is actually that good, then you know what? Too bad, so sad for any haters, right? But you know who that's good for is the people that are going to reach out to you and actually do business with you. So, man, that's an amazing story, and would love to definitely get more insight on what you think about the from, you know, based on your expertise, what you know, this is not just I'm not just asking anybody here, what do you think, right? Based on your expertise, what do you think about the real estate market in California right now? I have some accountants and CPAs who have definitely helped out a lot of realtors and built their business on serving that niche in this state, California. So that would be super interesting to hear just for me, but definitely I think California is a big housing market. So I think, you know, I could be wrong, but it would be impactful to the rest of the economy. So that's interesting.
Exactly. So this is a bit of a side issue. The license that we're using to be able to run the mortgage brokerage is actually a real estate broker's license. So one of the licenses that our agents, our outside agents, have to get is the real estate salesperson's license.
Interesting.
And over the last 20 years, a lot of them have said, hey, I want to participate in real estate transactions too, because they have the license, so why not? Well, the company I was with before would never allow it because they didn't know enough about it. And so one of the things that I decided when I started up my own company is that we were going to offer that as well. Okay. And something that I've discovered is the National Association of Realtors has really good lobbyists. They have a carve out in RESPA to where they can pay referral fees to each other and it's not illegal. I know realtors who don't really do any transactions, but they're active on social media or in the community, and all they do is refer out transactions all over the country.
Right. Yeah.
They're not licensed, and it doesn't matter because they're licensed here, and so their broker there pays their broker here, and they get a split. And they get paid huge commissions sometimes for making a phone call.
Yep. Exactly.
And that's legal as long as both of the agents are licensed. Whereas if two licensed loan officers tried to do that across state lines, or even if I couldn't do something and tried to refer something to someone down the street, we could both go to jail if we paid a referral fee. It's illegal to pay it and it's illegal to receive it.
Right.
And of course, both parties could be banned from financial services for life, which is why it's also a big deal for the CPAs to not get involved in anything they can't do, because it would ruin their careers too.
Right.
So,
and by the way, just to back you up, I mean, I'm seeing some of these conversations, and I mean, they're very excited to make money. So they're using words like, referrals. They're using words like kickbacks, and me in an accounting background, I just see that word. And I'm like, oh, what? What's going on? But it's legal. So that's super interesting.
So what I've done is I actually signed up with Coldwell Banker as a realtor to learn that side of the business. And that's part of how I've learned. I'm not doing a lot with that, but enough so that I understand it so that I can allow them to get paid on transactions that they want to refer out. Now, for the most part, they're not going to actually list a house and do that part themselves, because that's a lot more work than they're going to want to do. And they'd actually have to join the local board, which is difficult and everything else. But they can get so much money just by referring it out and letting the Relo department at a major brokerage handle all the details, that it makes it worthwhile. Now, over the past 20 years, there have been several times where I've, either for myself or for a friend or a family member, acted as their real estate agent on a purchase and just given them the fee. Because, okay, realtors can also give the fee to their clients. So if in order to make someone want to work with you, you have to give them $5,000 of your $30,000 commission, or you want to pay that to help them move or whatever, that's legal. But your loan officer can't give you anything.
Right.
And it just has to, the National Association of Realtors is really good when it comes to the lobbying and looking out for the interests of the realtors.
Interesting.
Now,
yeah.
So on some things, they're asleep at the switch, but I'm just amazed at what's legal there that isn't legal for me, even working under the same license and the same authority.
Yeah, exactly. That's super interesting.
Yeah.
And it's super interesting that you kind of point out the lobbyists for that, to achieve that for their market. That's interesting.
Yeah, because you would think, for example, that Chase or B of A could lobby so that they could pay referral fees to their agents across state lines and things like that, and it wouldn't be very hard to get that same kind of carve out. But they haven't done anything along those lines, and they could make a ton of money if they could make that legal. So the NAR is just smarter in some things.
That's interesting.
But your question was about the real estate in general. I think the real estate market here is softer than it was a year ago. The reason I wanted the segue about talking about my experience with Coldwell Banker is because in my market here, average purchase price in the little 3-town area where I live is about $1.5 million.
Right.
So you got a starter home at $1 million, $1.1 million, and then there's a lot in the $2 to $3 million range.
Mm-hmm.
The people around here, the realtors here, are disconcerted with how much longer things are sitting on the market than we think they should. The market is slower.
Mm-hmm.
They're not getting the multiple offers. Matter of fact, I was just reading something today about I just read an article in Mortgage Professional magazine
Mm-hmm.
that said that the number of transactions with multiple offers has dropped from 42% last year to
Mm-hmm.
10. So most properties are not getting
Yeah.
the multiple offers right now.
Yeah.
And I'm seeing, for example, I've got one client who tried to buy a house, and nice little place. It was listed for 425. It had been on the market for 3 weeks, and she said, "Okay, I'll pay your 425." And the sellers countered at 435 because they wanted multiple offers and they thought they were going to get more, and she just walked away. Now,
Interesting, man.
when a seller puts a price out there and someone says, "Sure, I'll take it," and then the seller comes back and tries to negotiate upwards, I am all for the client saying, "Screw you," and
Right.
just walking away on it, because
Of course.
you might say that they're not being reasonable, but I go back to my basic business law classes from when I was in college years and years ago, and I think
Mm-hmm.
you got an offer and acceptance. They said, "I want this much for this house." The terms say conventional or cash. Someone comes in and says, "I'll take it." You can't ask them for more, but they do it all the time.
Interesting. Yeah.
And I'm hearing more and more buyers who say, "No, I'm not going to cooperate with that," because they're not being upfront with what they're trying to do, and they don't like
Exactly.
the seller playing games with them.
Yeah. That's interesting.
So, and I've got clients that have tried to sell homes they bought last year,
Mm-hmm.
and have actually placed the list price underneath what they paid and not sold. So it's a little bit soft, but I still don't think we're going to hit it hard. What we don't have right now that we had last year is there was a lot of foreign money coming in that just isn't coming now because of the stuff that
Right.
the foreign governments have done.
Of
And
course.
then you've also got people that still really aren't comfortable with what the tax law changes mean to them.
Interesting. Yeah.
Because there were a lot of surprises in April this year. And so,
Yeah.
I know, understatement of the year, right? But
Yeah.
so they don't know what's happening. And when people are uncertain, they don't want to put themselves on the hook for a $2-3 million house.
Right. That's interesting. That's interesting. Yeah. I like that you use that word uncertain. I definitely, I mean, just to throw in, at least a marketing tidbit here, you at least, anyone marketing your brand out there, everything that we see online is very obscure, right? Or every business decision we make, it's very obscure. So people are uncertain, and as much as we can communicate and get rid of the obscurity, I call it erasing obscurity, right?
Mm-hmm.
That's to make prospects feel uncomfortable with something that they may feel uncertain about. So, wow, that's definitely valuable information on the market there, Russell. And by the way, audience, you know what? This is Russell's first podcast talking for this long. Is that correct?
Yes, it
Right.
is.
Right. So, you know what? I'm sure he's going to be on more, dropping even more value. But we're coming up on a bit of time here, so would love to, ask you an interesting question here, Russell, which is, I mean, you've already said, in the interview, you talked a little bit about your career. You've shown your expertise a little bit, dropped straight value for us. Just to make this valuable for the listeners, I would love for you to talk about any big challenges that you've had in your career or even your new business here.
Interesting.
Yeah, yeah.
So the biggest challenge that I've had in getting the new business up and running, we really only started in January of 2018 because
Hmm.
it took us a while to get the licensing in order and everything.
Hmm.
At this business, my wife is my business partner,
Love it.
and we actually both have real estate brokers licenses, so we have enough experience to go a tier beyond the salesperson so that we can both manage a company. So if we decide to split this off and do different things or have complementary businesses, she can run one, I can run the other, so that we have different signatures on whatever it is we're doing.
Nice.
It's gotten more difficult to get the licensing because of things that they've changed. It used to be that just with the real estate license, you were good to go in California. And now they have the NMLS endorsement that we have to get to that license. When you hear lenders advertising on TV and talk about that NMLS number, that's what they need
Right.
to be allowed to provide mortgages now. And it's expensive because in California, the state of California gets to collect the fees to administer it. So it's about $400 a year per licensee. There's more education required up front. Some people have issues passing the test, although I just had one guy take the test about 2 weeks ago and passed with flying colors.
Nice.
So the difficulty that I've had has been just in getting people to take the step, just because it's work to do it and it's harder than it used to be.
Okay.
And
That does sound like a challenge, but I'll say this for you. I mean, now that you've got 2018 handled and we're going into the 2020s now. I mean, I guess there are barriers to entry to do what you do. So that's super interesting. I mean, for me, there are so little barriers to entry to do what I do, right?
isn't that great?
Just market companies. It is great. And it's one of the reasons I felt like I didn't have to actually get my CPA to market CPAs. I just would have stayed at PwC if that was a barrier to entry. Oh, you've got to get your CPA to market CPAs, right? That's not true. but
Yeah, but you understand them, and so you can talk their language.
Right.
I've noticed that, and at my former company, the guy that was the best at recruiting CPAs was, do you call someone a former CPA, or are you just always a CPA once you're a CPA? I don't know.
Right, yeah, you can be a former CPA.
Okay, so he was a former CPA because he wasn't practicing, but he was still a member of Cal CPA or whatever that was. And he could just talk to people in a way that it made sense to them. And so he was really good at recruiting that way because they think differently. And for example, when you had, was it Eric Bergmeyer?
Right.
Who focuses on dentists.
Yep.
I've noticed that the CPAs that I've worked with that focus on dental practices have just phenomenal firms.
Wow.
That I've noticed that the ones that focus on that, it's because for whatever reason, they're able to talk to the dentist in a way that the dentist understands, and they're just a different kind of person. They think a little bit differently, and when a CPA focuses on something like that, I've found that their clients are very loyal and they stick with them forever, and they just move forward that way. And then their kids end up going to the same CPA and so on down the line, which is why I found it really interesting when you had him on.
Wow, that's interesting.
Yeah, it's just, the stuff that you pick up over the years, right?
Right,
so
right.
Let's see.
And
other challenges, it's usually just trying to see where the issue is for example, since 2009, appraisals have been something of a challenge because the appraisers, first of all, your mortgage broker isn't allowed to talk to your appraiser anymore, ever.
Okay. I didn't know that.
They've come up with complete appraiser independence, supposedly, because they blamed the financial crash on that instead of on risky investment vehicles being put together by Wall Street. What happened is Andrew Cuomo, as the Attorney General of New York, filed class action lawsuits against Fannie Mae and Freddie Mac, saying that their appraisal practices cost however many hundreds of millions of dollars to the people in his state. And in order to get out of that lawsuit, Fannie Mae and Freddie Mac agreed to come up with what they called HVCC, the Home Valuation Code of Conduct, which had rules where basically you had to put an appraisal management company in between the people asking for the appraisal and the people doing it. And I could never talk to the person doing it, which meant that they could provide shoddy work or take 3 weeks to even call the client for an appointment, and I couldn't call them up and cuss them out, and I couldn't assign it to somebody else. We had a deal that was so bad one time that the appraiser down in LA had to take a comparable sale from the other side of a freeway in a bad neighborhood where everything was barred up just to justify coming in so low.
Interesting.
And I couldn't do anything about it because I wasn't allowed to request a different appraisal. The only thing I could do is go to a different bank, but if the other bank's appraisal management company contracted with the same appraiser, I'd be stuck with letting him do it again.
Right.
And they're not on the hook for the quality of their work when they provide bad work. I've seen appraisals where they mismeasure a house by 3,000 square feet and then adjust it downwards against houses that are smaller because they say, oh, this level doesn't count.
What? Okay.
I'm not kidding. And we're no longer under HVCC because under Dodd-Frank, they incorporated those rules into it and came up with their own appraisal independence requirements. So the appraisals have been a challenge literally for the last 10 years. I just had one that I did in my backyard, basically, which is why I was able to know that it was completely bogus. House is worth about $1.4 million, and the appraiser came in at $1,090,000, realizing that to get the loan the client was asking for, we needed $1.1 million in value. He came in $10,000 under just because he could.
Yeah, interesting, man.
And because I had access to all the realtors tools in the area and had actually been inside all the houses, I was able to file a rebuttal on that and actually get them to increase the price enough to where we got it through. That's the only time I've actually gotten them to increase the value based on what I've done. And some of the stuff we've gotten is just garbage. Now, Fannie Mae is very frustrated with all this. Because of this, they're improving their automated systems to allow what they call appraisal waivers, where they say, we already know enough about this house. We don't need an inspection. We know the value. We're okay with it. And that's because they've come up with this more now because of all the abuses they've gotten from the providers of the appraisal services.
Right.
I think it's really
super interesting.
When Fannie Mae announced this new initiative 2 years ago, I was at the Digital Mortgage Conference in San Francisco, and the gal from Fannie Mae who spoke said, I already have enough data on 20 million homes in the US to where I can do a loan on them comfortably with no appraisal.
Interesting.
Yeah, it's crazy the way
that's so funky. Yeah, that's so funky, man. And I'll say this, just, to the audience, I think CPAs and accountants are so valuable just because from what I've assessed from a society is, well, no one likes to look at the actual numbers, right? So, I mean, Russell here is an expert at what he does, in the mortgage market, the real estate market. Not even CPAs like to look at the rules and regulations and the specifics of that. So I definitely think humans, and I get this from Gary Vee. I'm not just coming up with this out of nowhere, right? Humans are the asset, right? So do what you're good at. And I think, you know what, Russell, you've definitely proven that. So I appreciate your time here. And I will link how to connect with Russell below, but I will say that you should definitely connect with him on LinkedIn, by the way. And Russell, here's the last question, or really, it's kind of a chance for you to here it is. Go ahead and tell the audience what you think they just should know, right? Very briefly, what do you think the audience should know?
You know, there's in all of our industries, there's a big push to try to replace you and replace me with bots or call centers or apps. A CPA that is watching out for his clients and taking care of his insurance needs, his financial needs, his mortgage needs, is never going to be replaced by TurboTax. So I'm a big believer in providing value. Now, I know you've got the value add and sometimes that's overused, but I'm a big believer in that if you're watching out for them, you can save them a ton of money, and they're not going to switch to TurboTax or H&R Block if every time rates drop, they're saving $50 or $100 a month because you took the initiative to do that. It's a tremendous burden to take off their shoulders, just knowing when is the right time to do this. And if they go straight to one of the call center lenders, they're going to offer them a cheaper rate than I am, but it's going to be with 3 points plus closing costs or 4 points plus closing costs because they want that client to stick. And part of what I'm telling people is the market's going to give you that cheaper rate for free sometime over the next few years. If you can save money now, take it. And every time you can save money, take it. But if someone is a typical $400,000 loan and they go straight to one of these online lenders or call center lenders, they could pay $16,000 in closing costs when they should be paying nothing. That eats into their equity.
Definitely.
And they also shouldn't be calling their same lender up to do this. I've got a friend who's a veteran who his loan was purchased and that lender solicited him to refinance on a loan that would save him $400 a month, but it has $25,000 in closing costs. So it would take him 6 years to break even. Now, he could save $250 a month for free, but they're saying save $400 and pay the $25,000. Yeah, I mean, it's just, and he's a veteran, and this is a VA loan, and they're just taking advantage of him.
That's crazy. Yeah.
He doesn't have $500,000 in equity. He owes $390, and his house is worth $440. So they want to eat half of his equity in costs on this loan, and that's not an isolated case. That's standard operating procedure for a lot of these companies.
That's super interesting.
Get the client to pay as much as you can to buy down the rate, so we hold on to that transaction. You can save them from doing that, and that's part of what I'm coming on here to tell you is watch out for your client's interests. And I don't know, do you have any other questions on that? Or it annoys me so much because I gave him his loan originally. The bank I gave it to sold it, and it's the company that bought it that's trying to just nail these guys. And
super
it's
interesting.
a young couple. And I feel a certain affinity with him because he was deployed, and during his deployment, his son was born. And then when he came back, this bank is trying to just really take advantage of this young family.
Yeah, come on.
And when I was born, my dad was deployed in Vietnam. So I've always just felt a certain affinity to this family in general because it's so similar to how I started out.
I love it.
49 years ago.
Love it.
So people aren't watching out for your clients, and they don't know enough about these transactions to know what's best for them.
Yeah.
That's part of what I'm offering you, is the way to
Yeah.
handle that. And you can do the work yourself, or I can do it. But if you want to get paid for doing the transactions, and by the way, the company I left has paid out about $15 million in commissions to the
Okay.
CPAs and financial planners that have worked with them. So I mean, this is serious business that's
Right.
available.
Right.
But some of the ones who are the best at it don't even want to be involved. They just say, take the reins and deal with it.
Oh,
Just make sure my
interesting.
clients
Yeah.
are taken care of.
Yeah. So yeah, I mean, I just got to back you up and say, I mean, if you're a CPA, if you're an accountant out there and you don't really know what Russell is talking about, I mean, tell him, no, don't even ask him, tell him about your client's mortgage situations. Okay. And
Yeah, thanks,
I mean,
Juan.
yeah, I mean, come on. If they're not going to dig into that, like have Russell dig into it here, because I mean, I'll just have to back you up again with that affinity that you have for your veteran client there. Thank you for your service, by the way, Russell's client. And me coming from a poverty-stricken background, that's one of the biggest reasons I chose accounting as a business, major, is because I realized that, hey, man, not even the banks, just people in general, if they know how the numbers work, and then they have also, the lobbyists backing them up, the laws backing them up, plus they also know that you have a lesser knowledge of what's going on. Well, there's good people out there. There's tons of great people out there. But if people can rip you off, they're going to rip you off. And so what Russell is saying here is, what your clients don't have to pay those fees, right? Your clients don't have to get ripped off, basically. I'll put it bluntly,
Exactly.
right? So yeah, I mean,
and when
thank
you
you.
take care of them, they will be loyal to you.
Exactly.
The most important part is they get what's best for them.
Love it. No, that was a great final word there, and definitely loved having you on. I definitely appreciate your interaction online. And I mean, audience, tell me what you think about this episode below, and you'll see more videos from Russell. I'll definitely, he has much more to say, I'm sure. I'm kind of upset, like this can't go on for hours, because you've given so much value already. But thank you so much, Russell, for coming on CPA Primetime.
Thanks, Juan.